Today, we are pulling back the curtain on one of the most fundamental ideas in all of economics. We're going to explore the invisible rules that shape our world, from the price of a bushel of wheat to the design of your smartphone. We're talking about market structures, and we're starting with the purest, most foundational model of them all, perfect competition.
Just picture it. You're at a huge farmer's market. You've got dozens, maybe hundreds of stalls, and they're all selling, let's say, tomatoes. They all look pretty much the same. They're all tomatoes, right? Now, what happens if one farmer gets a big idea and tries to sell their tomatoes for $10 a piece, while everyone else is selling them for $1? Well, you know what happens. They sell absolutely nothing. That farmer has zero power to set the price. The market sets it for them.
Okay, now let's flip that completely on its head. Think about the launch of the latest smartphone. You've got just a handful of massive companies running the whole show, and they don't just accept a price from the market, they tell the market what the price is going to be. They are not price takers, they are very much price makers.
So, that brings us to the core question, doesn't it? Why is there this huge difference? Why does the tomato farmer have absolutely no say, while a tech giant seems to have all the control? This isn't just random chance. It's built into the very architecture of these markets.
And the answer, the key to this whole puzzle, is a concept called market structure. You can think of it like the blueprint for an industry. It's the underlying framework that dictates the rules of the game, the level of competition, and ultimately, how much power any single company can have. All right, let's get into it. Here's our roadmap. We'll start with the big picture, looking at the different kinds of market structures. Then, we'll zoom way in on our main subject, perfect competition. We'll figure out how a firm in this world makes its most crucial decision, how it survives the day-to-day of the short run, and then discover the fascinating, inevitable outcome in the long run. And finally, we'll connect all this theory back to the real world.
So, let's start with those invisible rules. You see, every single industry, whether it's local coffee shops or global car manufacturing, operates within one of these structures. And once you understand them, it's like you've got a decoder ring for the entire economy.
So economists basically group markets into four main buckets. On one extreme end of the spectrum, you have perfect competition. On the absolute other end, you have a monopoly. And then in between, you have monopolistic competition and oligopoly. Now, what's so powerful is that just three simple things, the number of firms, the type of product, and how easy it is to get into the market, pretty much determine everything. Today, our focus is right here, on the theoretical starting point for it all, perfect competition.
So let's dive deep and really dissect this thing called perfect competition. We often call it a theoretical ideal because, let's be honest, finding a perfect real-world example is tough. But, and this is a big but, understanding its pure logic is the key to unlocking how all the other, messier market structures work.
So what is it, officially? Well, a perfectly competitive market has a few key ingredients. First, a huge number of buyers and sellers. Second, they're all trading a product that is identical or homogeneous. And the big one, no single buyer or seller, not one, has any power to change the market price. They just have to accept whatever it is.
Now, to get that kind of market, a very specific set of conditions has to be in place. First, you need that vast number of buyers and sellers, so no one is big enough to make a ripple. Second, the product has to be homogeneous. They're perfect substitutes. A bushel of number 2 yellow corn from one farm is the same as from any other. Third, free entry and exit. This is huge. It means there are no barriers, no walls keeping new competitors out. And finally, some background assumptions. We assume everyone knows everything. That's perfect information, and resources can move around easily.
And all of those conditions, every single one, they all funnel down into one single, incredibly important consequence. The firm is a price taker. Full stop. It has zero, and I mean zero, control. The market sets the price, and the firm's only decision is whether to accept it or not.
Now, this is where it all clicks into place visually. Look at the left side here. That's the entire market. Demand slopes down, supply slopes up, just like you'd expect. Where they cross, boom, we get the market price, let's call it P. Now shift your eyes to the right. This is the world from the perspective of one tiny firm. Its demand curve isn't sloping at all. It's a perfectly flat, horizontal line locked in at that market price P. Why? Because if they charge even a penny more, everyone will instantly buy from someone else. And they have no reason to charge less because they can sell as much as they want at that market price. That flat line, that is their entire world.
Okay, so if the firm can't choose its price, what choice does it have? Well, it has one really important decision to make. How much should we produce? This question gets us right to the heart of the firm's strategy for survival and success.
And there is a golden rule for this, not just in perfect competition, but for any firm that wants to maximize its profit. And it is this: you produce at the quantity where your marginal revenue equals your marginal cost. Marginal revenue, MR, is just the extra money you get from selling one more unit. Marginal cost, MC, is the extra cost of making that one more unit. The logic is so simple, right? As long as making one more brings in more cash than it costs, you do it. You only stop when the last one you made cost you exactly what you earned from it.
Now, to be technically precise, there are two conditions here. The first one is the big one we just covered. MR has to equal MC. But there's a second, slightly more subtle rule. The marginal cost curve has to be rising when it crosses the marginal revenue curve. Think of it like this. If you're trying to find the highest point on a hill, you can't just stop when the ground becomes level. You have to know you were walking uphill just before you got there. That's what this second condition does. It makes sure we've found the true profit maximum, not a minimum.
Let's see this in action. Here's our firm's reality again. That perfectly flat line is the price, which is also its marginal revenue. Every unit it sells brings in the exact same amount of money. Now let's draw in the marginal cost curve, which usually has this kind of U-shape. So where's the magic spot? Right there. That intersection point. That is the profit-maximizing quantity. Let's call it Q star. Any unit to the left of that point, MR is higher than MC. You should make it. Any unit to the right, MC is higher than MR. You're losing money on it. That point is the only logical place to stop.
So the firm knows its optimal output. But here's the kicker. Does that guarantee a profit? Oh, absolutely not. In the short run, a firm could find itself in one of three very different financial situations. Let's break them down.
First up, the best case scenario. This is what economists call abnormal or supernormal profit. We'll add the average cost curve to our picture. If, at our profit maximizing quantity, the market price is above our average cost, we're in business. The firm is making a clear profit on every single unit it sells. And that total profit is represented by this shaded rectangle right here.
Second, we have the break-even point. This is called normal profit. Now, that might sound a little underwhelming, but in economics, normal profit is actually a good thing. It means your total revenue is covering all of your costs, including your opportunity costs, what you could be earning if you invested your time and money elsewhere. Graphically, this happens when the market price just kisses the bottom of the average cost curve. You're not getting rich, but you're sustainable.
And third, the situation no one wants, an economic loss. If the market price drops below the firm's average cost, then even when it's producing the optimal amount, it's losing money on every unit. That total loss is this shaded box. Now here's a crucial point. Just because you're making a loss, it doesn't automatically mean you should close up shop. That leads to a very important decision.
And that is the shutdown point. This is one of the most critical concepts for understanding how firms behave in the short run. Here's the rule. A firm will keep operating, even while losing money, as long as the price it's getting is enough to cover its average variable costs. Think of those as the day-to-day running costs, like labor and materials. Why? Because the firm still has to pay its fixed costs, like rent, no matter what. If it can make even a little bit of money above its variable costs, that extra cash can go toward paying the rent, which means it loses less money than if it shut down completely.
And this graph shows us exactly where that line in the sand is. We've now added the average variable cost curve. The shutdown point is right here, at the rock bottom of that AVC curve. If the market price falls below this level, the firm isn't even making enough to pay for its raw materials on a per-unit basis. At that point, it makes more sense to just stop, produce zero, and only have to worry about paying the fixed costs.
All right, let's pull the camera back. The short run is all about survival, about making these tough daily decisions. But the long run? The long run is where the real magic of this market structure happens. It tells a completely different and very powerful story. Here is the single most mind-blowing conclusion of this whole model. Remember that condition we talked about, free entry and exit? Well, in the long run, that simple rule acts like a giant, invisible, self-correcting force. And its ultimate effect is to take all those juicy, abnormal profits we saw and drive them all the way down to zero.
Let's trace how it happens. So, firms are making these great profits, right? Word gets out. Entrepreneurs see an opportunity, and they rush into the industry. As all these new firms start producing, the total supply in the market goes up, which shifts the market supply curve to the right. And what happens when supply goes up? Basic economics. The price goes down.
And this keeps happening. New firms keep entering and the price keeps falling until there are no more abnormal profits left to attract them.
And it works perfectly in reverse, too. What if firms are losing money? Well, some of them are going to go out of business. They'll exit the market. As firms leave, the total supply shrinks, which shifts the market supply curve to the left. With less stuff available, what happens to the price? It starts to rise. And it will continue to rise until the remaining firms are no longer losing money and are back to earning that sustainable normal profit. It's a perfect balancing act.
And this is the grand finale. This is the long-run equilibrium in all its glory. It's the point where all these market forces have done their work and everything has come to rest. And it's an incredibly elegant picture. The price, marginal revenue, all the short-run and long-run cost curves, they all meet at this one single point. And that point is the absolute minimum of the average cost curve. It is a state of perfect productive efficiency. No one's making extra profit, no one's making a loss. Just pure, sustainable, normal returns.
Okay, that was a lot of theory, a lot of perfect graphs. So the natural question is, does this beautiful, perfect model actually exist anywhere in our messy, complicated real world? And more importantly, what are the big ideas we should take away from all this?
Well, finding a 100% textbook perfect example is nearly impossible. But we have some really close approximations. Think about big agricultural markets, like for wheat or corn. You have thousands of farmers, and the product is pretty much identical. Commodity markets, for things like crude oil or copper, also operate in a very similar way. And you can even think of the stock market as a partial analogy. If you or I buy or sell a few shares of a giant company, we are pure price takers. We have absolutely zero impact on that stock's price.
All right, time for a quick quiz to see if it all sank in. First question, why is that demand curve for a single firm perfectly flat, or what economists call perfectly elastic? The answer is because the firm is a price taker selling a homogeneous product. It has so many competitors selling the exact same thing that if it raises its price by even a little, its sales will drop to zero. It has no pricing power whatsoever.
Okay, question 2. What is the critical difference between a firm that's making a loss and a firm that decides to shut down? A firm is making a loss anytime the price is below its average total cost, but it will only shut down if the price falls below its average variable cost. As long as it can cover its running costs, it's better to stay open and minimize its losses.
And our final quiz question. Why does this whole model predict that in the long run, firms will earn zero economic profit? It all comes down to that incredibly powerful force of free entry and exit. Profits are like a signal flare attracting new firms into the market, which increases supply and pushes prices down. Losses are a warning sign, forcing firms out, which decreases supply and pushes prices back up. It's a relentless process that always pushes the market back to that zero profit equilibrium.
So let's wrap it all up. If you remember nothing else, remember these 4 things. 1. The structure of a market is what determines a firm's power. 2. Perfect competition is our essential baseline model, the world of pure price takers. 3. The golden rule of production for any firm is to produce where marginal revenue equals marginal cost. And 4. That freedom of entry and exit is the powerful engine that drives long-run economic profits to zero.
In the end, perfect competition is more than just a theoretical model. It may be rare to find in its absolute purest form, but it is the essential benchmark for everything else in microeconomics. It's the standard of perfect efficiency against which we measure all the other market structures we see every day. Understanding this ideal is the absolute first step to truly understanding how our whole economy works.